People's Republic of China is a communist country whose economy has revolutionized over the past 100 years. In the 1940s, civil unrest and foreign pressures caused China's economy to struggle. The Chinese Civil War and the rise of communism initially caused an extreme rise in inflation. By the 1970s, the People's Republic of China understood that change was needed and started significant reforms. Among them included the disbanding of communes, which was a step in the direction of decreased government control. The Chinese market was slowly becoming more open and accessible. China went from a command economy to a market economy. With the more lenient economic policies, China's economy has exponentially grown and has become one of the most competitive economies in the world. Furthermore, China has become a part of the World Trade Organization and partakes in the Free Trade Agreement.
China's major resources include coal, iron, ore, natural gas, petroleum, and many other rare earth elements. It is the world's largest producer of agricultural products, and it plays the largest role in these key economic sectors: power industry, mining, services, coal, automobiles, natural gases, and manufacturing. China is particularly known for its manufacturing and industrial sectors in the economy. In 2012, manufacturers, miners, utilities, and builders accounted for over 45% of China's GDP. Since the yuan is so cheap, it is favored in manufactured items that are sold to foreign countries. China's major export partners are the United States, the European Union, the Association of Southeast Asian Nations, Japan, and South Korea. It exports electromechanical products, labor-intensive products such as clothing, textiles, furniture, and recently has been a major exporter in high-tech products. A large number of China's imports include industrial supplies, capital goods, and high-tech equipment. China regularly imports from developed countries like Japan and the United States. Recently, the Chinese government ventured outside of its communistic economic platform and adopted the Free Trade Agreement as their new platform that would allow them to open up their growing economy to the rest of the world. The Free Trade Agreement is an integrative approach to reaching out to the global economy. By adopting the FTA, China will strengthen economic interaction with trading countries. By joining the FTA, China has gained 14 FTA partners that made up 31 economies. Foreign direct investment is very important to the Chinese economy. China has successfully created an economic platform that entices outside investors. As of 2008, the Chinese economy successfully attracted 20% of all FDIs to developing countries, which surmounts to more than $100 billion. On a GDP scale, FDIs have measured up to 2.5% of the GDP, but this number may be deceiving. The percent is very low because of China's enormous population.
After the beginning of the People's Republic of China, the country valued independence and self-reliance, and although it attempted some economic exchanges, it was hindered by the complicated foreign relations brought on by the country's planned economic system. Because of this, the development of China's foreign trade was slow at best. This slow progress continued until 1978 when China enacted policies to open the country up to foreign trade. The goal of these policies was to drive modernization, promote economic growth, and increase the strength of China as a world power. China has continued along this path of reform and opening up through policies such as discontinuing all export subsidies, enacting tariff cuts, and reducing non-tariff measures such as quotas and licenses, and as a result has attracted foreign investment. The Chinese yuan operates under a managed float system against other international economic powers' currencies. Although the yuan has fluctuated over the years, it is generally agreed upon that the yuan is greatly undervalued below its real purchasing power parity, a fact which has spurred much international irritation because the artificially low value of the yuan makes its products much more competitive in the international marketplace and therefore hurts other countries' export industries.
China's technologies, market structure, and factor endowments all play a huge role in China's economic situation. For starters, technologies are rapidly developing an innovative portion of China's economy. This promotion of innovation is allowing Chinese companies to produce efficiently in terms of both time and cost, but also improves the quality of their products. With this constant innovation leading to a continued rise in output, which according to economies of scale will also cause the average cost of output to decrease, it is apparent that China's technological advances have and will continue to be a determining factor of China's foreign direct investment, trading patterns, and financial situation. Market structure played a major role in the original development of China's economic growth in 1978. As mentioned before, the People's Republic of China reformed from a command economy to a market economy. This has been a crucial part of China's rise in global economic standards over the last 3.5 decades. Factor endowments, though, which drive the law of comparative advantage along with factor intensities, are what truly explain China's economic situation. China has a relative abundance of many factors. Although only 12% of its land is arable, which is fairly average, China ranks third in the world in square miles. Another 5% of China's land is made up of freshwater lakes. China's land also contains every one of all 150 minerals in the natural world and ranked first in the world in titanium, zinc, and graphite, just to name a few. All of these resources are heavy incentives for the trade of everything from cash crops to aquatic products to minerals. China also, obviously, has an abundance of labor as they have the largest population in the world. Although this is a large reason for their extremely low wages, it also entices FDI from companies in other countries seeking cheap labor. Even more enticing may be the fact that the quality of Chinese labor is also growing through China's investment in human capital. Although their literacy rate was 95% in 2010, which is relatively low compared to most developed countries, the trend is China's friend. Emphasis on education by the Chinese government has led to an elementary school enrollment rate of nearly 100%, and getting an MBA has become much more commonplace for Chinese adults. This broad spectrum of educational growth emphasizes China's aim towards domestic innovation. It is clear that although technology and market structure have played and will continue to play a key role in China's economic success, factor endowments explain precisely China's trade, FDI, migration, and financial situation.
China is one of the largest recipients of foreign direct investment, and this plays a large role in its investment and tax revenue. Although it is big, it is becoming increasingly smaller due to rising labor costs and shortages of skilled labor. Foreign investors are also now beginning to compete with Chinese companies. Recently, the Chinese government has begun to strengthen enforcement on FDI. They have started to enact policies that focus on promoting the FDI that is associated with national priorities rather than FDI that does little for the Chinese economy. This includes upgrading industrial sophistication, supporting innovation, setting up outsourcing industries, and developing poorer regions. Many investors take advantage of the fluctuations of the international capital market and the regulations of the Chinese exchange rate policy. Some funds are introduced in the way of illegal joint ventures, which is essentially when a commercial enterprise is undertaken jointly by two or more parties that otherwise retain their distinct identities. Additionally, Chinese officials and exchange rate policies are having difficulty regulating false reports of total investment and the establishment of shell companies, which are inactive companies used as a vehicle for various financial maneuvers, or kept dormant for future use in some other capacity. All of these bring about potential risks for the future development of the Chinese economy. China has been a growing economy for years and years. Under the communistic economy, China limited its inevitable growth. Once the Chinese government realized its monster economic potential, the government made strategic moves to move China's economy towards a free trade agreement. The free trade agreement has allowed China to open itself up to the rest of the world, which has exponentially grown the economy. China's engagement with the rest of the world in trade has increased its per capita GDP. Additionally, foreign direct investments in China have increased China's productivity and provided their economy with newfound knowledge and know-how technical information. Through our research and knowledge of international economics, we have developed our own opinions on the economy of China. We decided to explore the profitability of future investments in the economy. Through China's foreign trade policies in the last decade, the country has stimulated the economy, built relationships with other world powers, and brought innovation and technology to the country. In the future, Chinese officials claim the following. These changes will improve the worldview of China as a country, economy, and trading partner. This will help them continue to grow at an estimated 7.3 to 7.4% in the next year. Although that growth is lower than the 7.7% rate at the end of the previous quarter, these changes will make the country a more legitimate and stable country and economy, and will guarantee it long-term growth, making it a great investment.